Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios here today. As you can see, I have a special guest. I want to welcome Peyton Rose Garland, my third daughter, to the program. She was born just 2 days ago on the 19th of December. So wasn't able to do the podcast at our scheduled time. Hence, here we are on a Sunday for a very special episode. Post the new addition to the Garland household, as well as probably the worst press conference of all time from our Fed chairman. So we got a lot to cover today, but wanted to get Peyton on the mic. This is the future of Shepherd Wealth Management, ladies and gentlemen. So you are welcome. Maybe 20 or so years from now, we'll have her as an official staff member here and potentially the new chairman and CEO. So just wanted to introduce her to the world, let everybody know that we didn't miss a podcast for no reason. This was a good one. Very healthy, 7 pounds, 7 ounces, nearly 20 inches long. So very, very happy and excited. Proud of her and my wife, Nicole, of course. So just wanted to kick us off with a wholesome moment here before I drop some serious bombs and rants for the rest of today's program. So welcome, Peyton.
Welcome,
And I'm
Peyton.
back to mom.
So very, very excited for all the festivities coming our way, but had to get a podcast squeezed in here before the end of the year, giving the hysteria last week post Fed meeting. And just had to get some of the stuff off my chest. Just a little bit of therapy for me today. So appreciate all the viewers that are here today watching us on YouTube. If you're new to the program, welcome. We got a lot to talk about today. Should be an exciting show. And if you have any questions, comments, feel free to leave those right here in the chat box for YouTube. We'll address those in future podcasts. Also, if you're new to the program, go ahead and hit the like and subscribe button. That way, every time we drop one of these, about every 2 weeks, you'll get a little message saying, hey, check this out. And we certainly appreciate the viewership. It's been a great year. 2024 is almost in the books. Market's going to post another 25+% type of return. A lot of stuff to look forward to for 2025, which will be for all of our viewers here today. That's exactly what we're going to be talking about in our next podcast right at the beginning of January. I'm not sure exactly what the date is on that yet, as we'll have to figure that out. But first show that we do in January will be a market outlook for all of 2025. So make sure to tune into that. And with that, Ez, we got a lot to jump into here, but anything that is on your to-do list here for Christmas? I know that we just watched the Bengals win last night, which was awesome. So there are slim playoff hopes are still alive. So it gives us all hope here, or at least something to do this coming Saturday, after Christmas, for all of the Cincinnatians around here, watching them play the Denver Broncos, who got to win out, which obviously means we got to win, and we need a whole bunch of help. So that's a big to-do list thing for me, is catching a lot of football before we get to January. Try to relax a little bit before we get into tax season, which is coming right around the corner in January as well. So yeah, that's on my to-do list, man. You got any favorites coming up for you?
Now, taking a little time to chill, hang out with family. That's really all. Different reasons though than tax season, but January is usually when for me. January to February is just nothing but office work. Applications for grants and exhibitions and all. That's when being an artist really kind of stinks, because all you do is sit in front of a computer and fill out forms.
I'll be right there with you, doing all of my compliance work right at the beginning of the year. Fresh paperwork that has to be sent out to all new clients as part of being an SEC registered investment advisory practice here. Very, very excited about that. Just caught the last show, a little bit of a celebration there for, in just 3.5 years, Shepherd Wealth Management is now registered with the SEC, which is very, very cool. Very, very exciting accomplishment. So yeah, I'm looking forward to 2025 in a very, very big way. So a lot to share about that. But today's show, I mean, what the hell happened in this particular Fed meeting? This was the worst press conference in the history of press conferences. So I write to clients every 2 weeks. We call it a blog, Shepherd Wealth Management blog. I'm sorry, we write that every Friday. My apologies. We do the podcast every 2 weeks. We write the blog every Friday, or almost every Friday. And I also write a newsletter to all customers at the beginning of the month. And the Friday newsletter, first of all, it was such a bad press conference that we had to send out a letter on Thursday, the day after the press meeting, just because it was that bad. And we got that many phone calls from customers being like, what the hell? Which was understandably, by the way. I'm not saying don't call me. Definitely call me, 513-630-2664. It was a interesting day, to say the least, that we're going to talk about. And what we're hoping to get accomplished here today is not just say what happened. I mean, the news does a good job of bringing things to your attention as far as what actually happened during a day, week, month, or an event that you should be aware of. That's what the news does a great job of bringing things to your attention. Thankfully, we all have these smartphones these days, which gets all that information to us very, very quickly. If we had the time or desire, we could dig into all that news information right at the touch of your finger, which is awesome. Love technology, and I don't hate the news. The news is doing its job, but their job is to be a for-profit business first and foremost. How they do that? They got to sell ads. Best way to do that is to engage human beings. So how would you go about doing that these days, you might ask? Well, there's actually a study called behavioral finance. You can get a PhD in this in pretty much every major university. They just blend finance and psychology. In other words, how do human beings make decisions or react to certain situations that are stressful relative to finances? And what we found is that humans feel losses twice as much as they feel good about making a gain. What that tells you is you're risk averse by nature. The news understands all this, of course, and because you engage with fearful things twice as much as you feel good about positive things, well, that's generally what you see as the headline risk, is whatever it is to be afraid of that particular day, week, month, year. Again, I'm not knocking the news. That's your job, folks. But what you should do as an individual investor, and what we do here for our clients and for our viewers, is we say, yeah, this is what's going on. The news got it right. This is factual information. However, there's always been some sort of precedent, other than the global pandemic, right, where they shut down the global economy for a year and a half. I don't have anything to compare to that historically, but over pretty much any circumstance, any period of time, whatever it is that's happening, geopolitical, interest rate related, whatever, there's a historical precedent for it. In other words, you can understand how other human beings behaved during a similar circumstance that we're going through right now. And what that does, it does two things that are very powerful for the consistency of your performance over time. One, it puts your emotions in check, right? It might feel very scary to see whatever the headline risk is, but if you can go back in history and say, oh yeah, we went through this 18 other times in the last 30 years, and here's the performance of the market, here are the actual performance of the sectors of the market. Now you're starting to put some perspective behind that potentially scary headline news that you just saw. But what you're also doing by controlling those emotions is you're able to see in real time probabilities of risk and reward. You can say, okay, well, maybe the overall market was okay, but these three sectors of the S&P really dominated during these circumstances. You have probabilities. Now you understand the risk and reward associated with every decision that you're about to make, and you can do so confidently. Buffett talks about the number one reason individual investors do not achieve the results they're looking for consistently is they have no control over their temperament. In other words, their emotions. So this is how we get control over that. So you're going to hear us today talking about some historical facts after we talk about what actually happened. And then I'll give my thoughts and opinions about it and how we're positioning folks for the new year. So that's in today's program. But you get that every 2 weeks here on the Shepherd Wealth Management Podcast. This is exactly what we're here to do. And unfortunately, the news did a very terrible job of breaking down what actually happened and why it happened the way that it went down. But before we even dive into what I have prepared here for everybody today, just logically put this into perspective. The whole world was watching this press conference, as they typically do when Jerome Powell has a Fed meeting or an announcement regarding rates and policy. And the whole world watching saw him do exactly what they expected him to do, which was cut interest rates by 25 basis points. He reiterated a strong economy. He reiterated a strong jobs market. He also reiterated the fact that jobs are not a pressure point for inflation. He acknowledges the fact that some recent economic data on the inflation front may not have gone as far down as they might have liked, as quickly as they have liked, but the overall trajectory of inflation is still heading towards 2%. As a matter of fact, we made some progress on inflation post the Fed announcement, which I will get to here in just a second. But the whole world, to put this into context, before we dive into it today, the man did exactly what the whole world was expecting. But in the last 90 minutes worth of trading, markets go from positive about 1% to negative 3 to 5%, depending on the index that you're looking at. What that should tell you in a very short nutshell is that markets like certainty. Markets were doing great before 2:30 this past Wednesday. Then he has to start answering questions that he doesn't have a teleprompter to give him those answers. He has to do it on the fly. And that's where all hell broke loose. The man just did a poor job of delivering a message that the whole world was counting on him to deliver, which was 25 basis point cut, strong economy. We're looking forward to 2025. We can see us reducing interest rates yet again, but we also have a lot of uncertainties going into the new year, given the new administration and the policies that they ran on. Not really sure how that's going to affect things, but we'll be in a perfect position to sit back and watch and react accordingly. Matter of fact, this should have been a victory lap type of press conference. I mean, no, in all seriousness, 18 months, 2 years ago, when the Fed went on this path of increasing interest rates at the fastest clip in human history, and they did not break the job market. Matter of fact, we've had stellar earnings results. Unemployment never got broke, even though, we increased interest rates at the fastest clip in history to stave off inflation that we haven't had that type of inflation for over 40 years. This should have been a victory lap. He should have just simply said, nobody expected us to be able to drive inflation back down towards a path towards 2% while increasing rates at the fastest clip in 40 years. We broke nothing. You're welcome. This is that, quote, soft landing that the news keeps talking about. You can call it and label it whatever you want. Soft landing, no landing. Who gives a shit? The reality is you did not break corporate America. You did not need to destroy jobs to make it happen. Nobody thought that was possible. I mean, the Fed's own track record suggests that this was an almost impossible stunt that they pulled off, which is getting inflation back towards a sustainable path of 2% without destroying jobs in the economy. They did it, folks. This should have been a victory lap type of thing. Matter of fact, at the beginning of this own calendar year in 2024, you can go back and look at our YouTube page from that period of time. We talked about it then. The market, not the Fed, but the market came into 2024 pricing in 6 to 7 rate cuts. We only got 4, and everything was fine, right? The market was trying to reprice itself at the beginning of the year because the Fed, came in with their dot plots, their summary of economic projections saying, hey, maybe 6 cuts, 7 cuts this year. And they had to scrap that after Q1. It got thrown the hell out the window. And we're still plus 25% on the S&P this year. Why? Because the Fed is still cutting rates. They're still your friend. But yet, as I'm sitting here today, a couple of days before Christmas, we got to watch all these dumbasses on CNBC talk about things that they don't even know what's going to happen regarding tariffs and its potential impact or not on inflation. I'm about to dive into all of this, folks. This was the most ridiculous and unnecessary press conference in the history of any press conference. And I'm about to make that very plain for all the viewers here today. Now, I think everybody understands that we strongly disagree with the way that particular press conference was handled. We wrote about this, as I mentioned last Friday. This is what we called a buy the dip moment. We also wrote a couple of weeks prior that there was this little zone of hesitation that the market had to get through. The last event was like, I think all the Fed chairman did during that particular meeting was confuse a lot of folks, which is why you're seeing a lot of volatility. But there's 3 things that he said that I have to talk about with the viewers today before we dive into any specific numbers. So first, Powell was asked, why more hesitant in 2025? So the reason for this question, the Fed meets, it's called every month on average. And then their last September meeting, they have their summary of economic projections. They call them dot plots. They do not do this at every meeting. So when they do come out with new, quote, dot plots, two things to keep in mind. One, it's stale data, right? It's based on data from the past, so it's not forward looking. And two, these are a gauge of every Fed member, and what they're doing is saying, hey, year out, where do you think inflation is, right? And they put a little dot, out there, whatever, 2%, 2.8, whatever that individual on the Fed board thinks about the future path of inflation. So the reason why this question was asked is why I'm more hesitant in 2025? Well, because last September's dot plot, summary of economic projections, showed the Fed cutting rates 4 times in 2025. Now, the futures market said, I don't think so. The futures market was pricing in 2 rate cuts for 2025. So we're going into Wednesday's meeting where the old stale data from the Fed back in September this year said 4 rate cuts for 2025. The market, which is looking at things here and now today and trying to price things in that may or may not happen in the future today, and the market's saying, yeah, we think you're only going to cut rates twice. So again, when we had Wednesday's Fed meeting and the announcement, expected 25 basis point cuts, we expected the Federal Reserve themselves to change their tune from last September. We expected them to be more hawkish. We expected them to say, hey, back off the 4 rate cuts for 2025 thing, probably going to look at maybe 2. And the reason for that, it has nothing to do with the economy. We're not too concerned about the labor market, although we have to keep an eye on it, right? Unemployment went from under 4 to 4.2, but anything less than 4.5 is damn good. So we got to keep an eye on that, but it's not too much of a concern for us anymore. And we have all these uncertainties coming into next year. I mean, that is what the market had priced in before 2:30 last Wednesday. So here's the question. Why is the Fed more hesitant going into 2025? They're talking about going from 4 cuts to 2. Here's what Powell said, quote, I can tell you that might be the single biggest factor is inflation has once again underperformed relative expectations. Powell on the labor inflation. Powell said this, look at the labor market. It's cooler by so many measures, now modestly cooler than it was in 2019 when inflation was well under 2%. So it's not a source of inflationary pressure. He's saying that the labor market is coming into balance, with the demand for workers and the available supply. So really the question was about why going from 4 to 2. And again, he said, quote, I can tell you that might be the single biggest factors. Inflation has once again underperformed relative expectations. He followed that up by saying that labor is not a source of inflation or causing inflation. Okay. So here's what we have to say about that. On inflation underperforming, this is what we wrote about in last Friday's blog. This is something we've discussed in the past. The fact that inflation is, quote, underperforming is due to 3 components. There's a whole bunch of metrics used to calculate things like CPI. So the excess CPI that we've seen over the last several months' readings, meaning that excess greater than 2% is 1.31%. So this excess inflation in headline CPI, this is not core CPI. I'm going to get to that. We got a core measure, PCE, last Friday was awesome. Obviously, the Fed didn't have that number going into last Wednesday's meeting. Probably would have been nice to have. But what we're going to call excess inflation, this is just headline inflation, CPI, not the preferred measure of inflation, but it is, the headline number that we get first before we get wholesale inflation, otherwise known as PPI. Then we end up getting core PCE, after all that. Core PCE is the Fed's favorite measure of inflation. We just got a reading last Friday. I'm going to get back to that. But the headline CPI, the excess inflation above 2%, is right now 1.31. So where's that coming from? What categories of CPI can we point to say, hey, where's this excess inflation coming from? There's 3 parts. One is shelter. We talked about this as, 2 years? We talked about shelter inflation having the longest lag effect. Everybody knows this. This is not a secret. The Fed talks about it constantly. It's just a really terrible measure of shelter inflation. Basically, they just take actual rents. If Ez goes and gets an apartment today in Nashville and signs a lease agreement, that data then goes into the Bureau of Labor Statistics data as actual rent that he's going to be paying today, brand new lease. Now, if I have a lease that I had 7 years ago and now it's going to be maturing in 2025, well, they're looking at the CPI data from my rent based on rent that I signed up for 7 years ago, right? So it's not reflective of what real rents are today. So that's the reason why shelter inflation in the CPI calculation has the longest lag effect, okay? And it's just a terrible way to measure it. There's probably a smarter way to do this, but this is what we got to work with right now. So the excess inflation on headline CPI, 3 components, shelters 0.87% of the 1.31% excess inflation. Auto insurance is the second biggest one. Auto insurance is positive 0.31. So an auto insurance is contributing an excess inflation of 0.31. The last one is recreation. So you guys out there traveling around right now, you're adding to inflation. No, I'm not saying that in a mean way, go do your thing, but recreation inflation is 0.05%. So those 3 categories, shelter at 0.87, auto insurance 0.31, recreation 0.05. You add all that up, that is 1.23% of the 1.31% excess core inflation. All right, take it from the bottom up. Recreation, what is the Fed going to do about that? Nothing. All right, you can increase rates, decrease rates, keep them the same. It impacts that in a 0% kind of way. Auto insurance. Is the Fed increasing or decreasing rates right now based on the auto insurance inflation? The answer is obviously no. The reason why the auto insurance is creeping up is because 2 years ago, when inflation started to become a problem, there weren't enough ships to go into your automobiles, your refrigerators, your everything, right? At that time, prices went up. If you're an insurance carrier and you provide auto insurance, well, if your car price goes up, insurance has to follow. It's a lag effect, okay? It's just the way it is. There's nothing the Fed can do about that regardless of what they do with interest rates. And they already know the impact on shelter. As I mentioned, longest lag effect, typically like a 2-year lag effect. We're starting to finally see inflation on the shelter front roll over, but it's still showing positive inflation. These 3 pressure points add up to almost 100% of the core excess inflation. So to say that we've underperformed is ridiculous. I mean, here's what we actually wrote for customers. The above highlights that core inflation is elevated mainly from shelter and auto insurance, not labor inflation, as Powell noted. We do give him credit for that. But we go on to write, does a higher Fed funds rate contain these 3 components? It's a rhetorical question. The answer is no. We know shelter is a matter of time due to lags of market prices versus impact on CPI. And auto insurance is already cooling from elevated levels and does not require further Fed intervention. And regarding the statement about Trump policies, now we got to get to this. So this was another big one that was asked during the presser last Wednesday. And the question was, how did members, including the Fed chairman himself, Powell, go about making their dot plot assessment, their summary of economic projections? Did they factor in this new administration, some of the policies that they ran on, etc.? Here's what Powell had to say. Quote, some people did take a very preliminary step to start to incorporate highly conditional estimates of economic effects of policy into their forecast in this meeting. Some people said they didn't do so. Some people didn't say whether or not they did or did not. So here's what we wrote about. Regarding the statement about Trump policies impacting Fed forecast on inflation is very unusual. After all, this is the opposite of data dependence, which is exactly what the Fed said that they were all about. They want to remain this independent agency from the federal government. Congress set up the Federal Reserve as it stands here today. Congress essentially elects on who gets to serve on this particular board. President obviously has something to say about that, but it's essentially Congress that created the Fed. And Congress is who the Fed chairman has to answer to effectively. Now, all we heard from Jerome Powell and every Fed member for 2+ years as they were increasing rates, as they were decreasing rates was, hey, we need to be data dependent. We need to let the data come out and assess the data and go meeting by meeting. That's all we've heard for 2 flipping years, okay? But Powell and his Fed heads at this particular meeting decided to get political for no reason at all. They didn't have to do it. They could have simply said, hey, we're an independent agency. We work for the American people. We've made substantial progress on inflation. We were able to accomplish something that nobody thought that we could do. Now we're going into an administration that a lot of people may be excited about, some people maybe not so much, and we'll just have to wait and see, how they go about doing their business and how they get implemented, for how long they're implemented, etc. But they decided to throw themselves right into politics. And the truth is, you can't not say that, because a lot of the members of the Fed, including the Fed chairman himself, Jerome Powell, they're not hiding behind what political party they're for or against. And I don't care. I could give a rip whether you like Democrats, Republicans, you're an independent, whatever. You've said for 2 years you work for the American people, right? You have a job to do, which is control inflation, and keep a strong labor market. Those are your 2 mandates. You said that constantly. But now you decided to get political here. So here's what we actually wrote about. Given what we just heard Fed Chair Powell say, that some members took into consideration this new administration in their dot plot summary, some didn't, and some didn't tell you whether or not they did or didn't. That sounds like a dumbass meeting to me just from the jump there. I, as the leader of the Fed, would have said, hey, do not take this into consideration because we don't know. We don't know. We told people for 2 years we're going to be data dependent. So you come up with your assessment and do not factor in things like tariffs or whatever else that you either are for or against with the new incoming administration. We are a politically agnostic agency. That's what they've been saying forever. But here's what we have to talk about now that they want to get political. So regarding the statement about Trump policies impacting Fed forecasts and inflation is very unusual. This is what we're writing to clients on Friday. After all, this is the opposite of data dependency. This is assuming Trump policies on tariffs and deportation will cause inflation. They simply do not know how the new administration's policies may or may not impact inflation. I do know this for a fact, though. If the price of oil remains right around $70 a barrel or less, it's going to be very freaking hard to make an argument for inflation is going to rise. It would be really difficult given the fact that, gas prices and oil prices affect everything in every industry that you could possibly participate in. So just keep that in the back of your mind here. Regardless of how you might feel today with tariffs, immigration laws, again, you don't know what's going to be implemented, what's not, what probably is being used as a negotiation tactic to get things that are more pro-American is my guess. I mean, hell, we've already had 4 years of an administration led by Trump, and last I checked, there was no damn inflation. And there was actual increase in tariffs that we haven't used in decades for sure, right? So we actually can go back and look at history in this example and say, yeah, we increased tariffs. We haven't done that shit in decades, and there was no inflation to speak of at all. But yet, Fed members are going to get political in how they go about assessing the future path of their policy, not understanding what is actually going to take place here on January 20th and beyond. So again, I don't care if you like the new administration, don't like the administration, love the policies, hate some of them. My job as a financial professional is to look at the situation and say, how is this going to affect people's portfolio? Is this going to hurt them? Is this going to help them? And then go from there. I could give a rip of what you politically think about anything. That is not your job, and that's not my job. Additionally, we go on to say in our Friday blog, this is a paradox. Consider this statement by Trump. I won on border and I won on groceries, as the president-elect said in an interview on NBC News, quote, Meet the Press. Thus, if Trump won on inflation being a problem, do you think that he would pursue policies that are inflationary? Therefore, we see the action by some Fed members as caution about Trump-driven inflation as paradoxical and essentially wrong. It's as plain as I can make it, folks. They literally said exactly what the whole world was expecting. Delivering a 25 basis point cut, economy is really strong, labor is no longer a cause of inflation, labor market looks great, it seems to be in better balance. We pulled off something that nobody thought was possible 2 years ago. And now we're going into a new administration with a very strong economy, a very strong labor market. Inflation's on a path towards 2%. I know that we talked about 4 cuts in September's meeting. We're looking at next year right now, thinking maybe 2. But given everything that's potentially could happen, might not happen, don't know when it'll happen, we're going to continue to be data dependent and politically agnostic, allow the data to come in and respond accordingly. That's not what he said. That's all he had to say. Should have been a victory lap, but he decided to go ahead and blow up the market, let the Dow drop by 1,100 points, and saw small caps decline by 5%, even though small caps were leading the way substantially before 2:30's press conference. This was completely avoidable, and I think a bunch of BS. Personally, knowing that Powell is a Democrat, and again, I don't give a rip, whatever, man. Why would he do this? When you had every chance to take a victory lap here, why get political now? It makes no sense. Now, here's what actually happened, and we're going to provide some historical context related to what actually happened in the markets after he started answering some questions. So we mentioned the stock sold off. The volatility index, the VIX, spiked by 74%. I mean, 74% spike in the VIX in the last 90 minutes of freaking trading on Wednesday. This happened as he's answering questions. Like, you can literally, next time they do a Fed press conference, for all those that are interested, have it on TV, right? And then maybe on your laptop or something else, have the S&P or the NASDAQ or pick an index and just watch that thing go tick by tick as this dude's answering questions. It's unreal. VIX spiked 74% in the last 90 minutes of trading on Wednesday as he's answering questions. So here's what history has to say about events like this. Now, believe it or not, there are 5 precedents that are very similar. I'll give you the dates. So on February 5th of 2018, VIX spiked 116% in one day. December 18th, 2024, last week, VIX spiked 74%. August 5th, 2024, VIX spikes 65%. That was before the Fed September meeting when they said they were likely to cut rates 4 times. So obviously we got a nice recovery from that. February 27th, 2007, VIX spikes 64%. That was just before the major correction that we went through, just about a year later. January 27th of 2021, 62% spike. That was right around the global pandemic. So you got 2008, the global pandemic, and then a bunch of shit that just happened here recently. All around Fed stuff, by the way. So the February 5th thing in 2018, Fed was jerking around with rates then. They got it wrong. They had to fix it in late 18. So that's the most 5 recent big spikes. And here's what's notable about how quickly the market actually recovers after stuff like this. So those were 5 instances, right? 1, 2, 3, 4, 5. I just rattled off there. And 3 out of 4 times, the S&P 500 fully recovered within 1 week. January of 21, February of 28, August of 2024. The median 3-month gain is 9%, and the S&P 500 was positive 4 times. We're going to see what happens here on this 5th time. But if you look at the S&P 500, got the gains back 3 out of 4 times within 1 week. And overall, 4 to 4 times the S&P was certainly positive just 1 year later. So this is all going to be short-lived, most likely. But you're still seeing people on the news. Again, the news does a good job of staying in business by placating to those human emotions. And all you're seeing these people talk about is 2 things. One, they're talking about potential impacts on tariffs and immigration. Again, unknowns. You can go back to the prior administration's policy as it relates to things like tariffs. They implemented tariffs. Haven't had that happen in a long ass time, as I mentioned before. That didn't cause inflation. A lot of it was used for negotiating tactics. But yet again, you got, people, including the Fed chairman and people that make up these dot plots and make these decisions regarding monetary policy for the Fed are taking tariffs and the potential impact or non-impact into their outlook and basically assuming that there's going to be an impact on inflation. They're also saying, the second thing that they're saying on TV right now, as I'm sitting here delivering this podcast to you all today, is they're talking about sticky inflation. Well, I just gave you the 3 components that are the excess headline inflation. If you want to call it sticky, fine. Shelter takes a long ass time before it starts to roll over for all the things I just talked about. But we just got the Fed's favorite measure of inflation last Friday, what they call core PCE. And the core PCE number came in at 0.1. The market was looking for 0.2. So it literally came in at half of the inflation that the market was looking for. That's the big reason why last Friday we got roughly, not all, but let's call it roughly half of the losses back from that Wednesday market meltdown that bled into Thursday of last week as well. So this is just, it's completely unnecessary. It's completely unbelievable that these quote unquote very smart, prestigious professionals are factoring in unknown things into their forecast, which is now bleeding over into retail investors' brains and causing them to freaking panic. And it's very obvious when you look at something like the VIX. Unfortunately, the news does a brutal job of reminding everyone that these are buy the dip type of events, given the recovery and the quick recovery at that the market has when things like this have happened in the past. So you're welcome for being a viewer here. And this is exactly why you want to continue to watch this program and share it with your friends and family members throughout the holiday season. But a couple other things to note here. Finally, we wrote this to clients on Friday of last week. Fed funds futures sees one additional cut in 2025. This is down from the 2 to 3 cuts that were priced in the market prior to the Fed meeting. I talked about that. We actually do believe that it would be better for the Fed to make fewer cuts in 2025 because this would extend the rate cutting cycle into 2026. And if the Fed continues to cut rates, this is a tailwind for stocks. So don't fight the Fed. I actually believe because the Fed decided to get political in this last meeting that they had, I actually believe that given the prior administration's track record with inflation and the non-impact that it had on inflation, that the Fed's probably going to be doing more than 2 cuts. They told you they're going to do 2. 3 months ago in September 24, they said they were going to do 4 cuts. Now they're saying 2. It's very likely, I'd be willing to bet a lot of money that the Fed does more than 2 cuts next year. But it would be fine by me if they did only 1 or 2 in 2025, because I still think the economy is going to be awesome. You're still going to have a very strong labor market. You have a president that's going into office. He looks at the stock market like a scorecard on how well he's doing. I don't think he's going to come in with a bazooka and blow up the market and inflation problems spiking now with terror. I just don't see that happening. Think what you want of the people running or not running the country the way that you think they should or shouldn't. Again, it means nothing to me from a professional perspective. When I deliver this podcast, it means nothing to me other than how markets may be impacted. And right now, they're causing volatility where they don't need to cause volatility. Again, this was a historic and unprecedented feat that the Fed just pulled off by wrangling in inflation without destroying the market after increasing rates at the fastest clip that's happened in 40 damn plus years. Why get political now? But even if the Fed doesn't do 2 cuts, if they do 1 cut, they do 3 cuts, they're basically telling you that they need to do another 6 cuts. They're telling you that the neutral rate is right around 3%. Well, if we're at 4.25 today, you got some cuts to do. If you're only going to do 25 basis points at a time, that could be about 6 rate cuts. If they don't do them all next year, great. Don't fight the Fed. They're going to continue to have to cut rates into the future. And oh, by the way, for those that don't see how they're going to do that, well, again, core PCE came in last Friday at half of what the market thought was going to happen. I'd be willing to bet strongly that that continues, given the lag effect on shelter. And eventually there won't be any auto insurance excess premium inflation, and then you won't have any freaking inflation. So I'd be willing to bet that as inflation continues to fall, if the Fed wants to stay higher for longer, if you will, meaning that they're not going to do 3 or 4 cuts next year, they're going to keep rates roughly around where they're at right now with just a cut or 2. Was inflation falls, if the Fed doesn't counteract that with a rate cut, well, now you're staying more restrictive. Isn't the whole point of monetary policy is to keep a thriving economy going instead of breaking a thriving economy, they're going to have to cut rates. I mean, you can get as political as you want. The numbers are what they are. Right? Eventually, you have to look at it and say, well, damn, inflation's coming down, and if we don't cut rates, then that actually makes us way more restricted than we have to be. It also forces the government and taxpayers to pay more in interest on the deficit that we already have than necessary. Seems like a dumbass policy to me. The Fed does need to get to neutral. Fed funds currently around 4.25 to 4.5. Neutral rate's about 3%, maybe 2.5. That would imply about another 6 interest rate cuts. So the fewer cuts that actually happen in 2025, hey, whatever, brother. That's just going to roll into 2026, and you do not want to be fighting the Fed. And by the way, that big spike that I mentioned, 74% during the last 90 minutes of last Wednesday's trading session, that was the second highest spike in the VIX in the history of tracking the VIX. Okay, this was unnecessary, didn't need to happen. I rest my case, folks. It was unnecessary and it was absolutely ridiculous. So there is some historical goodness behind it. If you did understand this, then you should be buying this dip in the places that we like to buy it the most, with a Fed that's decreasing interest rates, with a labor market that's basically fully employed, with corporate profits strong, with an administration that ran an entire campaign on cutting taxes and making it a very pro-business, U.S. first type of policy. Seemed to work out pretty good last time that they tried a lot of this stuff. Did not cause inflation. The things that I would want to own under those circumstances hasn't changed. It's something that we've talked about all year long. As this was because I'm sure I'm going to have to talk about all the same stuff with all of our relatives and family and friends throughout this entire Christmas and holiday season. So I may just pull up this YouTube channel and say, hey, watch this, go grab some popcorn and a beer, and just go chill for 40 minutes and check this out, because this is how I feel about it. I'd rather not have to talk about this again. But yeah, we got that out of the way, brother. So we made it, and I feel much better for it.
Good. I'm glad you got it off your chest. I'm also dubious to the fact that this is the last time you're going to have to address it. If, the Financial Shepherd podcast history is any indicator, to use your favorite metric, historical data, I would say that we'll have to be addressing this again well into 2025. There's no way that we've seen the last of it. So.
Yeah, hopefully what we're doing in 2025, whenever. So the Fed will meet in January. There's like a 0% chance that they're going to cut rates at all in January, I should say. Then they'll meet again in March. And right now there's a little bit better than a coin flip's chance that they cut in March. If we continue to get core PCE numbers just like what we got on Friday, they'll probably have to change their tune on their dot plots and their messaging. Because if they're only going to do 2 cuts, maybe only 1 cut next year, if they do 1 in March, it gives them a lot of time to bake in another 1 or 2. So yeah, basically the Fed put themselves right in the center of attention going into 2025. I was looking forward for a year where we didn't have to talk about that at all. I was hoping the Fed would be a non-issue for the first time in damn near 3 years. But they decided to throw themselves right in the middle and center of attention for all things finance related. So yeah, we'll be talking about it. We'll be watching, but hopefully, sometime March, April, May-ish of next year, I'll be saying, hey guys, go watch the December 23rd podcast that we did on YouTube for 2024. And I can just say, I told you so, because, we already talked about it. So pretty sure I'm right, but this is also an opportunity for me to be very wrong and have egg on my face in 4 or 5 months from now. But I'll take the good with the bad. So far, we've been pretty damn accurate. Don't expect that to change at all. But if it does, we'll call it out. I'll eat it, and you guys can have some fun with that. But for now, that's how we feel about it, and we'll see what actually happens. So we'll be happy to do this again in a couple weeks. Make sure you are staying tuned to the Financial Shepherd podcast in January, right at the beginning of January. We will be providing our 2025 market outlook. So I'll be going over expectations for performance, where we maybe see the S&P finishing the year, providing a ton of historical data in that particular show because we're going to be coming into 2025 on back-to-back 25+% type of performance in the S&P 500. That's only happened a handful of times in the last 100 years worth of market data. So I have a lot to share with everybody. I'm very excited about that. You won't want to miss it. It'll definitely impact the way that you're thinking about your portfolio and performance expectations for 2025. So it's either going to be another banging type of year, 20+%, or it's going to be a little rocky. And we'll certainly provide our take on that. Looking forward to it. So don't forget to send your questions to us, 513-630-2664. On behalf of Ezra, myself, the entire Shepherd Wealth Management community of clients, and my business partner, John Ashcroft, and all the family members that support us in doing what we do, we thank you guys very, very much for being allowed to do, the best job on the planet. This is definitely a dream of mine, and I'm very, very thankful to have the opportunity to do it. I'm thankful for the programming. I'm thankful for the opportunity to deliver this type of message to you a couple days before Christmas and everything that we've been able to accomplish. I'm very proud of it, but I'm even more excited for the future. So thank you guys very much for your viewership. I hope you all have a happy Christmas, happy Hanukkah, Kwanzaa, happy Festivus, if that's what you're into. We might have to have our own Festivus after the family members leave. If you're not familiar with what I'm talking about, go watch Seinfeld this holiday season on Netflix. Look for the Festivus episode. It's awesome. Until then, hope you guys have a happy new year as well. And God bless. We'll see you then. Take care.